Hello, my fellow investors, and welcome back to another fundamental analysis video from your guys' recommendations. Because, as I said, we are going to continue this series up until earnings season comes out again, which is towards like the middle to the end of July, if I'm not mistaken. So today, guys, we're going to take a look at one of your recommendations, and that was actually brought up by Tony in the exact same comment that he requested, I believe, GPN in, and it is none other than the company Paycom, right? Paycom. This is a company that, honestly, guys, I've already taken a look at the fundamentals, and wow. Wow, that's all I got to say. Just absolutely wow. I'm actually really excited to see what the valuation is in regards to this. We shall find out. But before we get started, make sure to like, subscribe, comment. It really does help her with the algorithm on YouTube as well as Rumble. Make sure to follow us on X at Fatal Investing. The link or the @ should be right under me. And of course, if you would like to join our Discord, it is linked in the description below. Shouldn't expire. So if you guys would like to join there, I try to talk sometimes. Mike tries to talk sometimes, but there's a few people that are there that you guys can chat with, get some information, stuff that we just don't know as much as other people do, right? We can't know everything, but that's what the Discord is for. And with that said, guys, let's get started with this analysis. So let's take a look at the company profile. We got Paycom software provides cloud-based human capital management solutions delivered as software as a service for small to mid-sized companies in the United States. It offers functionality and data analytics that businesses need to manage the employment life cycle from recruitment to retirement. The company's HC Solutions provides a suite of applications in the areas of talent acquisitions, including applicant tracking, candidate tracker, background checks, onboarding. Okay, so basically, guys, this is the kind of company that employers use to it's very similar to like ADP in a way. I believe other companies use like Paychecks, and other companies use like a bunch of other different sites like these, but I'm thinking that that's essentially what that is from. So it's actually something that it'll become more prevalent as time goes on. I mean, I'm pretty certain all companies use this, right? I'm pretty sure all companies use this type of format. So, it's a type of thing that I don't think will ever go away. If anything, with AI, it'll probably get a whole lot better. Now, I know the whole thing about AI, right? But at the end of the day, guys, it will eventually upgrade a lot of stuff when it comes to the overall performance. My whole issue with AI is something else related. We're not going to get into that right now, but just understand that with more AI as it comes out, the more it develops, the more extensive it gets. Sure, there are some bad stuff to it, but there will be some good stuff as well, and something like this will definitely benefit from AI. Now, with that said, let's jump into the overall earnings, because they had earnings on, as you guys can see right there, May 1st, and we can see that okay, right off the bat, this is insane. This is absolutely crazy. EPS normalized actual $2.59 beats by 13 cents. EPS gap actual $4.34 beats by $2.45. That's a massive, some might say huge beat. It really is. Like, seriously, it really is. Revenue actual $499.88 million, and this was a beat by 3.7 million. Now, their next earnings is on August 2nd, and their EPS normalized estimate is estimated to be at around $1.59. The EPS gap estimate $1.09, and revenue estimate of $436.39 million. And we have 16 total revisions, 13 of them to the downside. Very surprising there, because wait until you guys see this overall graph. It's absolutely insane, man. This company is I gotta say, I love it. I love getting 52-week low companies. Seriously, if you guys could get me more 52-week low companies, that's like that right there. That's perfection. It really is. So with that, let's actually move now into their actual earnings summary. We got Paycom non-GAAP EPS of $2.59 beats by 12, revenue of $499.9 million beats by 3.72 million. Guys, this revenue, look at this revenue beat. Oh, so obviously at 3.72 million, but the year over year, 10.7%, absolutely massive. We got over here recurring revenues of 491.9 million, increased 7.7% from the comparable prior year period, and constituted 98.4% of total revenue. Wow. Financial outlook, we got Paycom provides the following expectation. Oh, they don't even mention anything when it comes to the financial outlook. It's barely anything. As you know me, I will show you guys their financial outlook. I'll also leave it in the description below, just so that way you guys can see it for yourselves. Quarter ending June 3rd, total revenues in the range of 434 million to 438 million. Adjusted EBITDA in the range of 151 million to 155 million. Year ending for, okay, so that was just for the quarter. Now for the whole entire year, we can see total revenues in the range of 1.86 billion to 1.88 billion dollars. And adjusted EBITDA of 720 to 730 million dollars. So now let us jump into the calculator. This is where things are going to start getting really good. We got over here the ticker for PAYC, market cap of $8.56 billion, a PE of 17.98. So that's really low right there. Current share price of $147.40. So now let's take a look at this graph, because this is where things just completely, honestly, this is where I'm just like, what is going on with this? On the 1 year, they're down 52.82%. Year to date, we got down 28.7%. This thing is at 52-week low, guys. Why is it falling? I gotta be honest, I don't know. This is the first time I'm looking at this company. But man, unless there's something terribly wrong, wait until you guys see those fundamentals, because unless there's something terribly wrong, this is really uncalled for. We got the 52-week range of $140.12 to a whopping $374.04. I mean, yeah, we're nearly at 52-week lows right here. You guys can see that, you know, on Friday it gained 1.18%, and post-market lost around 0.07%, but still though, 52-week low, again, doesn't mean that you buy, but it's a great starting point to start looking further into companies. So let's come back over here. We can see that they do pay out a dividend, which is also a treat, of $1.50, guys, $1.50. And if we take a look at this dividend, this is a yield of 1.02%, a payout ratio of 18.96, really solid right there as well. No 5-year CAGR, no dividend growth years. However, if we take a look at the history, here's the reason why, right? I mean, if we take a look at the max, guys, they started paying out a dividend in 2023, May 25th of 2023. So they only have a year. So I look at this and I'm like, okay, so far so good, I guess. You know, we really can't have a history unless we have actual history here. So they recently just started paying out this dividend. Ex-dividend date passed as of May 24th. Payout date was on June 10th, and they do pay their dividends quarterly. If we come back over here, we can see that this $1.50 makes up around $82.5 million in dividends being paid out every single year based off of the 10-year average free cash flow, and then you subtract this $82.5 million right there, you get 44.81 from their average 10-year free cash flow. If we take a look at this into their last year's free cash flow, it is at around, what, $209.9 million. These payout ratios, though, are absolutely crazy, because as of the last year's free cash flow, it is 28.21. Really good, right? That's really good. The 10-year average free cash flow, it is 64.8. Here's the thing. It depends how the graph looks like, right? Because you would expect that, you know, 10 years ago, the free cash flow was a lot less. So that would make the average a lot lower. So we're going to take a look at the overall graphs right now, and this is where things take a turn. Wow. They take a wow turn. That's essentially how I'm going to call it from now on, the wow turn. So now that I moved my face cam up here, because you know you guys love when I do that, let's start off with the net income. We got, look at this, guys. This is insane. We got 10 years ago of $5.7 million to 1 year ago of $341 million. That graph is crazy. This graph right here, absolute insanity. Pretty much consistently increasing, all except for 1 year during COVID. That really is it. Right, that really is it, where they dipped down from 180.6 million down to 143.5, but in the following year they made it up, right? They made it up from even what the past 5 years ago was, right? 180.6 to 196 on the dot. Guys, this is a massive increase of 5,879%. this is an easy 100%, right? I'm not going to look at this blip and be like, oh, no, it's bad. It was COVID. It's just like, I can't really blame them for it, right? So now let's take a look at the free cash flow. This is what I'm talking about, right? You got to take a look further into just the whole entire thing. By the way, even what I'm doing right here is not a deep dive, right? It really isn't a deep dive. I don't know why the company is falling that much, right? I don't know. That's something for you guys to talk amongst yourselves and maybe to even tell me, because if it's nothing of issue, this looks like a possible great buy then. And here is the reason why. Look at this free cash flow, guys. You saw that dividend on the 10-year average free cash flow. The payout ratio is around 65%. Well, there's a reason why. 10 years ago of $8 million to 1 year ago of $292.4 million. That is an increase of 3,555% with an average, guys, of 127.31. This average is going to be taken down due to this right here, obviously, right? Now, I'm going to give this a 95%. And the reason for it is because there's just a little bit of stagnation from 6 to 4 years ago. Still increasing, but not perfectly increasing, right? So that's what I'm going to give it a 95%. All in all, this graph looks absolutely perfect. It really, really does. Now, the revenue, it just honestly keeps getting better. We got 10 years ago of 151 million to today of $1.7 billion, guys. That is an increase of 1,022.4%. I mean, basically, this is a perfect graph. I would like it for the trend line to hit those graphs a little bit more, but all in all, it's an easy 100%. So the profit metrics, you got 100%. Right, for the net income. You got 100%, or sorry, 95% for the free cash flow and 100% for the revenue. You already know what this grade is going to be, right? I mean, it's pretty obvious at this point. The total assets of reference only looks really, really solid, as well as the liabilities. Now, the assets minus liabilities also look pretty crazy as well. We got over here consistently increasing once again. Looks very similar to that of the revenue in general. Total average assets, we got 2.45 billion. Liabilities of 1.824 billion, a difference of $628 million. Easy 100% as well, right? Easy 100% as well. Now, the cash flow minus the liabilities, unfortunately, this one is heading down a massive amount. It really, really is. Now, the cash flow is increasing, but the liabilities are increasing much more than that of the, than that of the cash flow. You do have some instances of this increasing, like from 7 to 6, as well as a little bit of increase from 5 to 4. All in all, though, as of 1 year ago, you're at negative 2.6 billion, and the average is negative 1.55 billion, guys. This is the worst one right here. It's 10%, but honestly, usually if the other 4 are good, this one usually is pretty low as it is. Now the next one, shares outstanding. This is the one that really kills me sometimes, because you have such great companies and then they dilute the hell out of you. However, take a look at this. We got 10 years ago 53.8 million to today of 55 million shares. Guys, that's such a tiny number. It's such a tiny number. 55 million. I like it if it's just like in the hundreds of millions. This is 55 million. This is nothing. This is absolutely nothing. This is a slight increase of 2.23% on the 10-year. And then a slight increase again, previous to the current year, of 2.04%. Now, I'm actually going to give this 100%. Here's the reason why. Guys, they issue when they have to issue, and they buy back when they have to buy back. There's even instances here where they kept it the same. What this tells me is that their share outstanding management, by the way, I think I'm going to coin that as well. Shares outstanding or manage, I don't even know how to coin it, but they're managing outstanding shares. There you go. I think that will, you guys can tell me in the comment section what sounds better. This is impeccable. This is impeccable. This is perfect. This is exactly what I want to see. Companies issuing shares when their share price is overvalued or they feel like it's overvalued, and then buying back when it's undervalued. This is perfect. So that's what I'm going to give it, guys, 100%. Perfect. Absolutely perfect. And lastly, cash equivalents, they currently hold 371.3 million with an average of 168.84 million. Overall grade, this is an A company. This is an A company. I cannot believe my eyes right now. This thing just got 1, 2, 3, 4 hundreds, 195, and then 110% because it's bad. But man, is this Is this a diamond in the rough? Let's find out with now the valuation. I'm pretty sure this is what a lot of you are wanting to see. So now let's actually get started with the discounted free cash flow. And by the way, guys, this is the second time I have to record this. I also just realized as I'm editing the video that it's I forgot to change. I was doing something on OBS and I forgot to change the resolution, so it's gonna look a little bit grainy. This one should be better, a lot better. But the main reason why I'm redoing this is because I noticed a little bit of an issue when it came to the discounted free cash flow for some reason. I don't know why that was the case. Yeah, it was giving me like a really high cash flow for next year, and it really just didn't make any sense. So I'm gonna have to fix that. I'm gonna definitely have to fix that. Yeah. Anyways, let's actually take a look at this one now. So we get over here, guys, not adjusting for debt, $161.24, and adjusting for debt, $329.23. So we can see that it's already in line with what it was, or what it is right now. So let's input some numbers. For the projected share buyback, I'm going to say -1, 0, and 1%. Because we have seen instances in the shares outstanding that they have done this, right? They have kept it the same. They've issued as well as, also bought back. So that's why I'm going to put it, guys, at -1, 0, and 1%. Now, for the revenue, this is where it gets a little bit tricky because you have 29%. And on top of that, guys, it's very consistent. So I'm going to have to say, I don't even know. I just don't know. If they continue to keep this kind of steady thing, I'm gonna say something along the lines of like not 25, sorry, 15, maybe. I'm gonna go at it a little bit low, so 15, 20, and 25%. Now you guys are looking at these numbers and you're like, that's absolutely massive. However, with the required rate of return, let's say it at around 20%. And well, with this, we get $56.71 to $129.66. Adjusting for debt, $119.52 to $266.78. Margin of safety of $510.15, $101.60 to $253.45. Very interesting, right? Very interesting to say the least. It's looking like a good price right now. In accordance to adjusting for debt, you guys can see that we are smack in the middle between the lowest assumption as well as the highest or the median assumption. Does this mean that you buy it at this point, guys? Not necessarily. The fundamentals do look good though, right? The fundamentals do look really solid. So that may be a reason to buy, but if the calculator is correct at all, which again, I'm so terribly sorry. I don't know why it occurred. The 5-year one should be okay though. But the 10-year one just wasn't having it. So yeah, I'm gonna have to fix that. The 5-year ones for you guys though should be good though. So yeah, nonetheless though, this is looking like a pretty good buy as it stands right now. Again, not financial advice. Every investment is the present value of all future cash flow, as I say in every single video. We could expect this thing to fall a little bit more or a lot more. And if it does, honestly, if these fundamentals hold, it's looking like a great opportunity to buy. Now, if we take a look at these dividends, guys, this is a company that, you know, it just started paying out a dividend. So $1.50, putting in $6,215, this only gives you $63.25 in dividends. So yeah, it's not really that much. It is what it is, right? It is what it is, but it does have a lot of prospects to increase that dividend in the future. So all in all, when it comes to Paycom, guys, fundamentals look good. Valuation apparently also looks really solid. My biggest thing is figure out why the company or the stock price is falling this much. I don't know what's been currently happening with them. Fundamentally though, everything looks solid. I don't know what else to tell you. Let me know in the comment section if you guys know what in the world's happening with this company, because I really am genuinely curious. So thank you guys so much for watching. Make sure to like, subscribe, comment. Really does help with the algorithm on YouTube as well as Rumble. Make sure to follow us on X at Fatal Investing. And if you'd like to join the Discord, link is in the description below. So with that said, peace out, and we will see you all next time.